All right. Your next topic is investment in debt securities. What we have done so far, we have covered investment in equities. If your holding is between 0 to 20%, I'm sure you would have got it fully understood that it is measured through fair value. If your holding is between 20% to 50%, then we use the equity method, right? Now, what if you have investment in debt securities? Why we are doing all these? Remember, our title of Unit 3 is long-term items related to measurement, valuation, and disclosure. So when we say debt securities, what exactly is included in debt securities? Debt securities includes redeemable preferred stock. What is preferred stock? We discussed it earlier. Preferred stock are the stocks that are preferred over the common stock. They are preferred for the payment of dividends. They are preferred in the distribution of liquidation when the company is closed. So preferred stock are the type of common equity, are a type of equity, but they are preferred over the common stock. That's why they're called preference stock. I'm sure you have all the understanding from your previous lectures. Ji Subhan wa alaikum assalam. So redeemable preferred stock means the preferred stock that has a specific life term, 5 years, 10 years, and after that, the preferred stock will be cancelled. The money would be paid back to the preferred stockholders and preferred stocks are gone. So they are called redeemable preferred stock. Mandatory means they have to be. It is not at the option of the issuer. Mandatory means they have to be cancelled or they have to be redeemed after a certain period of time. Irredeemable means that are forever lost. If it is irredeemable, they will be considered as a part of equity. Redeemable preferred stock is like a debt. When you borrow money from the bank, you have to pay it back. Irredeemable means these preferred stock are forever. Absolutely, Brad, they are forever. So, redeemable preferred stock, it is considered as a debt security. Preferred stock that is redeemable at the investor's option. Now, I would like to spend a few minutes on this. Such preferred stocks are called callable preferred stock. Means those investors who bought these stocks, they can, after, of course, a certain period of time, maybe the time limit is given 5 years. So when the 5 years are over, the purchaser, the holder has the option to take these preferred stock back and put it in front of the company and just ask them for your money. So remember, those preferred stock that are in the hands of investor, they can give it back after a certain period of time. They are called puttable. Sorry, I just called callable preferred stock. They are called puttable. Mind the word. Puttable means that the holder can put these preferred stock in front of the management or the company and ask for the money back, right? So if the preferred stock are puttable, means they are in the hands of the investor, they can redeem it after a certain period of time. They will be considered as a debt security. And the third one are called collateralized mortgage obligation. Like, for example, company has a sizable piece of land and company has issued bonds using this land as collateral. So when a property used to issue bonds, such obligations are called collateralized mortgage obligations, because in case if there's a default, then these collaterals property will be disposed of and the money will be paid to the investors, right? So what is not included in debt securities? Leases. It is not considered as a debt security. We will discuss the new leasing standard in your financial reporting in the coming lectures. And these remaining specific areas we will do in your CMA Part 2, Section B, Corporate Finance. Options, future contracts, forwards, they are discussed in CMA Part 2. They are derivatives. So remember, just for the sake of names, that these are the specific items that are not considered as a debt security. Now, debt security will be redeemable preferred stock. Those redeemable preferred stock that are puttable, that is, they have the investor has the option to put them back, or any collateralized mortgage obligation, right? So we have learned how to deal with the equity securities. If you hold between 0 to 20% and 20 to 50%, that's what we did yesterday. Now, when you hold debt security, you can decide to put them in any of these three categories. It's your choice. At the date of acquisition, what do you want to do with those debt securities, those preferred stocks, those collateralized mortgage obligations? So there are three categories. Let us discuss them briefly, and then we will see how do we do the accounting for these categories. The first category is held to maturity. You hold these investments, you hold these redeemable preferred stock or these collateralized debt obligations till the time they mature, up to 5 years, up to 10 years, whatever the maturity period might be. So if the company decides to designate these investments as held to maturity, the company should have the positive intention to hold them for 5 or 10 years, and company should also have the ability to hold for 5 and 10 years. Ability means the company will not have any cash problems, so company can hold it till the preferred stock and these collateralized mortgage obligations, they become matured after 5 or 10 years. So this is the first category, held to maturity. You will hold on to these investments till they mature, right? So this is the first categorization. Second, you hold these preferred stocks, you hold these bonds with the intention to sell them in the near future. If you do, if that is the intention, then we say that these debt securities have been designated as trading securities. You trade, buy, sell, you frequently do that, right? So if the intention is to hold till maturity, accounting is different. If the intention at the acquisition is to trade, buy and sell frequently, then these bonds or these debt securities will be classified as the trading security. Now, if the bonds are neither for HTM, held to maturity, nor trading, then there is a third category called available for sale. So it's neither classified as held to maturity nor trading, then it will be called as AFS, available for sale security. So these are the three classifications, and all of these have different accounting treatments. Now let us see how different they are. What do we do in their accounting? So let's move to the next slide. Let's do the first categorization. You hold bonds, you hold preferred stock till maturity. Held to maturity is the classification, that is the designation of these investments. So debt that you want to hold till it matures. Now, how do we do these specific treatments? Now, let's say you purchase a security, a bond, or a preferred stock for, let's say, $10,000, right? What if the price goes up to $12,000? What if the price falls to $8,000? The fair value changes by the balance sheet date. What we do with this? Remember, if you have designated your security as held to maturity securities, if the fair value goes up or goes down, you do nothing. Mafi, no entry, nothing. Any unrealized holding gain, any unrealized holding loss is ignored. Right? Remember, held to maturity securities, they are unaffected by the volatility in the market price. You keep them at a certain price. I will tell you what that price is going to be. So held to maturity investments, bonds, preferred stock, their value in our books, it is not influenced by the volatility in the market price. There is no gain and loss, no unrealized gain and loss reported in the income statement. Then how do we record it? It is recorded at an amortized cost. We will discuss a little bit of bonds in your next chapter. Let me explain a bit idea. You don't need to know it right now. Okay, sometimes a bond that has a par value or a face value of $1,000, it is sold at a higher price, maybe $1,050. A bond that has a par value of $1,000 is sold for $1,050. This $50 extra, this is called premium. Right? It is possible that a bond that has a par value of $1,000, it is sold at $950. Now, why would it happen? Why a bond with a par value of $1,000 is sold at $1,050? The reason being that in this case, you are offering a rate, a coupon that is higher than the market rate. Your offered rate is higher than the market rate, so the market is willing to pay more price for your bond than the face value. And in case if your offered rate or coupon is less than the market rate, a $1,000 bond will sell for $950. There is a specific video if you're really interested in knowing how the premium and discount, in this case it is discount. A $1,000 bond is sold for $950. This $50 is the bond discount. I will share a video in our group. Please remind me if I forget. That contains a detail how we premium and discount is accounted for. It's not in your syllabus, but you need to know. So the point to remember here, that if I purchase a bond for $1,050, with the passage of time, it will fall in my books to $1,000. This is called the premium amortization. 1,050, 140, 130, 115, 18, 15, and by the time the bond matures, my book value would be exactly $1,000. So remember, if the bond or the preferred stock is designated as a held to maturity, it is reported at amortized cost. How it is done, I'm going to share a video with you because that is not necessary for this specific topic. So 1,050 will fall with a specific computation, and by the time it matures, the face value and the book value, they will be exactly the same. On the opposite side, if you have purchased a bond for $950, why? Because this bond is offering a rate or coupon that is less than the market rate, so you paid less amount. So this keep on rising every year. By the time the bond or the preferred stock matures, it will be exactly $1,000, mean the book value and the par value will be the same. So the point here to remember that if the investment is designated as held to maturity, 1,050 will fall shoya and becomes 1,000. That shoya is what you call the amortized cost. Whatever the amount becomes 1,025, 1,015, that amount is called the amortized cost. 1,050 will fall to 1,000 at any balance sheet date. What the value is on the books is called the amortized cost. Similarly, this $950 bond will go up in value through an accounting treatment. You will know with that video I will share, and it will become $1,000 with the passage of time. So this amount at particular point in time on the balance sheet is called the amortized cost. It is absolutely unaffected with the volatility in the market price. Whatever the price is, no gain, no loss if in case the price goes up or goes down. Yes, one very important point you need to learn. Let's say I have a bond in my books at $1,150, let's say. Now, what has happened? The market price of this bond has fallen permanently, and it appears that the price is not going to reverse. Let's say if it falls to $920, then even we are not falling the market price, but if the decline is permanent in nature, then I have to change my amortized cost to the new base. Now the $920 will be the new base. That is very rare, but there's a question you will find in the Gleim software. That is, the fall in price is permanent, then the new market price, which you consider to be the permanent price, you can write down your bond value to that point, and the differential would be the loss. That's the only exception. Otherwise, you will report your bond at amortized cost. Whether it's the discount bond, the premium bond, you will have to report it amortized cost. So this is the first classification, held to maturity. Next classification, that you have decided that you will frequently buy sell this bond or this preferred stock. This is called the trading category. Bonds are held to be sold or to be bought. When you say trade, that means you will be frequently selling and buying them. So bonds with intention to sell them in the near future. So it means that the intention is to trade in them. Now listen to me very carefully. Let's say if I purchase bonds worth $10,000, right? If the price goes up to $12,000, this gain of $2,000, it is reported in earning. Yes. Recognize holding gain and loss? Yes. If there is a gain, it goes straight to the income statement, earnings. If the value falls to $7,500 at the balance sheet date, there is a loss of $2,500. Will you recognize this loss, holding loss? Yes. Remember, this is the holding loss. You haven't actually sold the bonds. These are called holding gains and loss, or unrealized holding gain and loss, which have not actually been realized. Okay, realized means when you actually sell them. So this 2,500 reduction in the value of the bond will be reported as a loss in your income statement. And why is it so? Because you are measuring your bonds, your preferred stock, at the fair value. If the fair value goes up, fi nafa, that's the profit. If the value falls, that's the loss that you have to report in your income statement. So remember, for trading bonds and preferred stock, change in the price at the balance sheet date is your income or loss to be reported in your income statement, and you report these securities, these bonds and preferred stock at their fair value on the balance sheet. Now, if the bonds and preferred stock are neither trading, nor are they for the purpose of holding them till maturity, then what? Then there is a third classification called available for sale. Your bonds are not in other two categories, then they fall in this third category, available for sale. Then what we do in this category, let's say the same situation, you have bonds worth $10,000. That's the purchase price, the cost. The price can go up by the balance sheet date. It may fall down to $7,000. So what we do in this category, in this case, yes, there is a gain. In this case, yes, there is a loss. But if the bonds or preferred stock are available for sale, that gain and loss that you see here, it is not reported in the income statement. Rather, it is reported in the other comprehensive income. I hope you remember from your first unit that other comprehensive income specifically includes 4 different types of transaction. One of them was the gain and loss on available for sale debt securities. So if there is any gain and loss, it is not reported in the income statement. Rather, it is shown in the other comprehensive income as a gain and loss. I'm very sure you people know that. I'm assuming that because we discussed this concept in much more detail. So gentlemen, if your bonds or preferred stock are designated as available for sale, any fair value gain and loss is not your income, is not your loss. Rather, that gain and loss is reported separately as a component of your other comprehensive income. What it is, I'm not going to spend my time on this topic, which we have done in much more detail then. So the point to remember here that let's just go back to the main table. Trading securities and available for sale securities, they are reported at fair value on the balance sheet date. The difference is the gain and loss on trading securities, it goes to income statement, whereas the gain and loss on available for sale securities, it goes to the other comprehensive income. It's a very important point to be remembered. And held to maturity, they are shown at the amortized cost, and there would be a loss only if the value falls permanently. Now let's move on and see what do we have next. Yes, I told you that if there is an impairment, the price for an amortized bond or amortized preferred stock, it falls permanently. Then the new price that is currently prevalent will become the new base. Now we have 3 categories: trading securities, available for sale securities, and held to maturity securities. That's the 3 classification you have. Now, let's say at the inception, when you purchase these investments, these preferred stock and bonds, you classified them as available for sale. So does it mean that it will stay as available for sale as long as you hold them? The answer is no. You can always switch from trading to available for sale, from available for sale to held to maturity, from held to maturity to trading. Any combination is possible. But if you have exercise the fair value option, gentlemen, that's one-way route. Fair value option means once you have elected your bonds and preferred stock to be reported under the fair value option, there is no other option. You will have to follow this till they are sold or disposed of. Please keep that in mind. But other than, I'm sure you would remember we discussed this in our previous class. GT road, one way, I would say motorway, Lahore, Islamabad. Okay, so if fair value option is not exercised, then if you are in any of these 3 categories, you can switch here and there. Ross says, will this option be given? It's totally up to the choice of the management, how they want to treat their investment. They want to take it as a available for sale, trading, or because it is advisable to select any of these categories because you can switch around. But once you fair value option is elected, boss, there is no way back. You have to treat these. Yes, you have the option at the acquisition date. You have the option to decide. But if you have elected fair value option, no way to turn back. But recommended that you should elect any of these 3 so that you can switch around, you can move around. So we have the text here that doesn't make much sense. The same has been tabulated here, which will make much more sense. Now I'm going to explain each of these in detail. Please try to make sure you understand it well, because if you don't, you will have difficulty in answering questions. Now, let's say you want to move from trading securities to other classification. And what other classification you have? Either you can go for available for sale, or you will go for held till maturity. So let's say if you move from a trading security to either available for sale security classification or held to maturity, right? Any category means any of these 2. Since under trading security classification, any gain and loss in the fair value is already recognized in the income statement, right? Trading security means any gain and loss in the fair value, it goes to the income statement. So if you move these trading securities to available for sale through HTM, any gain and loss has already been recognized and it is not reversed. Any gain and loss which you have previously recognized as a fair value gain and loss on these trading securities, it's there and it is not reversed. It makes sense. The gain that has already been reported in the income statement, it is not reversed, right? Now, next, let me highlight and then discuss it in detail. Any category to a trading category. Now, what are the two possibilities? Either you are moving from held to maturity to a trading category, or you will be moving from available for sale to trading category. Now, let us see these one by one. If you're moving from held to maturity to trading security, let's say if you're holding certain investment in HTM and that has a book value of 8,000, which you call the amortized cost. HTM are reported at amortized cost, it's 8,000. Now, when you decide to convert them or to transfer them into trading security, there are two possibilities. Either these HTM securities have a market value of 11,000, or it is possible that they have a market value of 7,000, let's say. In this case, when HTM is converted to trading security, at this point, there is a gain, and that gain must be recognized. I'm on the second, or yes, I'm in this line, right? I was just thinking about this. Okay. Now, if this $8,000 amortized cost is now converted into trading security, and if there is the fair value is 11,000, in this case, this 3,000 gain, it is reported as a part of income statement. If not already recognized, this goes to income statement, right? If this HTM results in a loss, this 1,000 loss goes to the income statement. So the point is, when an HTM is converted to a trading security, any gain and loss on this conversion goes to income statement, right? Now let's move to the available for sale security. We know that any gain and loss in available for sale security, it goes to and it accumulates in other comprehensive income. Any gain and loss on the fair value measurement on available for sale securities, it goes to the other comprehensive income. So when we decide to convert these AFS into trading securities, all the accumulated gain and loss so far will be released to your income statement, right? So any gain and loss that has accumulated over a couple of years or for whatever the period for which you have held these investments, any gain and loss accumulated in other comprehensive income will be released to income statement. So that's it. Any category to trading, you must recognize the loss if not already recognized. Makes sense? Please revisit, rewatch this specific area once the lecture is over. This is important. Now, the third one. Held to maturity is now being converted into available for sale. We know held to maturity bonds and preferred stock, they are reported at amortized cost. What is it? You will know in a separate video. I will share it in the group. And now it's being transferred to the available for sale. Remember, held to maturity is reported at amortized cost, 8,000, maybe 11,000, whatever the value is. Now, what you're going to do when you convert this into AFS, and at that point in time, the AFS has to be debited, and now the price could be 11,000. At that point, the price could be 7,000. Now, in this case, there is a gain $3,000 and there is a loss of $1,000. This gain, in case of available for sale security, it goes to other comprehensive income, because we know any gain and loss on the fair value measurement of available for sale security goes to other comprehensive income. So if there's a loss, that goes to OCI as well. So it's fairly straightforward. When an HTM moves to AFS, now it's an AFS. So during this transition, this transfer, if there's a gain or loss, as usually it goes to other comprehensive income. Now the last category, and let's discuss and move on. Now we are moving from available for sale to held to maturity. AFS is now being transferred to held to maturity, which means we had some securities, preferred stock, bonds, which were designated as AFS, for which any gain and loss was already reported or accumulated in other comprehensive income. Now we are converting them in HTM, held to maturity. Now the previous gain or loss that is already available in the other comprehensive income related to this bond or this preferred stock, this gain and loss will be amortized. Amount in the OCI, whether it's a gain or it's a loss, it is not reversed, but it is amortized in the same way as premium or discount. Now, what is premium and discount? I hope you remember. A bond of $1,000 sells for $1,050. Why? Because the coupon is more than the market rate, or a bond that has a face value 1,000 is sold for $930. Why? Because the coupon is less than the market rate. This $50 is called the premium. This $70 is called the discount. And this is what is amortized every year. How it is done, the computation, it's all coming in your group. Please do watch if you really want to understand the discount and the premium amortization. Otherwise, for this specific topic, you just need to know what I've told you. But if you want to go for deeper detail, you will get it. So, gentlemen, if there is any gain and loss related to these AFS which are being transitioned into HTM, that gain and loss will be amortized in the same way as you amortize premium and as you amortize the bond discount. And I'm sure you would learn it in detail later. Now, there is a beautiful table given that sums up in a very unambiguous way whether your investment will be treated at an amortized cost, whether it will go through fair value through income statement, or should it be OCI. It's a wonderful layout. Let me explain this to you in detail. All right, now please be with me. This is the flow chart, the decision table that will help you greatly in deciding whether the investment to be reported at amortized cost, or should it go through fair value, or should it go to OCI. Wonderful, wonderfully arranged. Now, let's see. First question you should ask yourself, are the contractual cash flows means the preferred stock dividend or the interest that you will receive on those bonds, preferred stock dividend or the bonds. So it could be, yes, principal and interest, the full redemption amount of the bond or the preferred stock, or any interest on preferred stock dividend. So are the contractual cash flows related to the principal or interest? Is it the only cash flow you are interested in? Are the contractual cash flows for an investment in the debt securities solely from principal and interest? If it is solely from principal and interest, the answer is yes. I just want to earn interest. I just want to earn preferred stock dividend, and I want to get my full money back. If this is the only interest, if this is the only thing you are interested in, yes, then the next question you should ask yourself that, am I interested in the cash flows only, just the cash flows only, the cash flows related to principal and interest? The answer is again yes. Then the next question, did you elect the fair value option? Because once the fair value option is elected, it is irreversible. It's a one-way road. So was the fair value election elected? No. Then you have to report it as an amortized cost. Beautifully arranged. Now, just see the flow, beautifully flowing things. Now, if you hold bonds and if you hold a preferred stock, you just want to have cash flows. You didn't elect the fair value option, which means your intention is very clear. You want to hold on to these investments for a long period. You want to hold them for a longer period. This means you have to then report it at amortized cost. Your intention is to just get the interest and the principal. It means you're waiting for redemption. You're waiting for the bonds to be redeemed. So in that case, this is the treatment. Investment is measured at amortized cost. All right. Now, if the answer is no, I'm not interested in just the cash flows or the principal, then the next question you should ask yourself that what's the purpose? Do I want the contractual cash flows, principal and interest, and I also intend to sell my investment? This means you have the intention to sell. It is no longer held to maturity, right? So if you want to sell also, if the answer is yes, then again the question will ask yourself, was the fair value option elected? No. Now in this case, since you have made this investment to receive the contractual cash flows, and you also have the intention to sell, and the fair value option was not exercised, was not opted, it means then you will have to report it as an available for sale security, and then you will report any gain and loss in the other comprehensive income. Otherwise, if you are interested to sell the investment, you're also interested to receive interest, you're also interested to receive the principal amount. Was the fair value option elected? Yes. I told you fair value election works in exactly the same way as the fair value measurement, because any gain and loss in the fair value measurement and the fair value option, that gain and loss goes to the income statement. So if the answer is yes, the fair value option was elected, yes, any gain and loss on these bonds, on these preferred stock, they go to the profit and loss account. Now the last leg. You're interested in principal and interest. I'm not interested in principal and interest, which means you don't intend to hold till maturity. You're not interested to receive interest. Then what you're interested in? You are interested in selling them. In that case, this investment is a trading security, which means any fair value gain and loss goes straight to your income statement. Right? Right here, we have one leg remaining. You are interested in the cash flows of principal and interest and are also interested to sell. Right? If the answer is yes, you fair value option. If the answer is no, I'm not interested in the cash flows, interest and principal, that means you have the intention to sell, and that goes to the profit and loss account through fair value adjustment. So if the decision is to be made that what in the intention, this flow chart, this decision table will help you decide that whether the investment is to be reported at amortized cost, should it go as available for sale security in which the gain and loss is routed through the other comprehensive income, else it's a trading security which you want to sell in the short term. So this must be done carefully, done repeatedly so that you fully understand the idea. Let's do a few questions that will explain your understanding. Which of the following statements with regard to marketable securities is incorrect? Please, gentlemen, when you see a statement or something like that, you have a facility on your exam simulation on the in the Prometic Testing Center. You can highlight any key point which you think is very important, and you should always be mindful of that particular point. Highlight that. There's a highlighting option in the exam software. Now, which of the following statement with regard to marketable securities is incorrect? In the trading portfolio of marketable equity securities, unrealized gains and losses are recorded on the income statement. This is true. If the securities are trading securities, yes, trading securities, fair value gain and loss, it goes straight to the income statement, correct? The held to maturity portfolio consists only of debt because debt has a maturity. Debt has a specific maturity. So this is a statement that is true as well. Debt securities may be transferred from held to maturity to available for sale. Yes, we just discussed that. That is true as well. Then what is not true is what most of you have given the option. In the available for sales portfolio of marketable debt securities, unrealized gains and losses are recorded in the income statement. This is absolutely wrong, because available for sale gain and loss, it is routed through the other comprehensive income, Rahat excellent, not in the income statement. So that makes B to be the incorrect option, and that is the right answer. Next. Fahad, my friend, this is the question for you, dedicated to you. The following information was extracted from company's December 31st balance sheet. We have non-current assets, and in those non-current assets, we have available for sale debt securities carried at fair value. Of course, available for sale securities are carried at fair value, and that's what we have just learned. Okay, so this is the carrying value. Accumulated other comprehensive income, that's where we report all the losses and the gains related to this investment. Now, what we have here, let me highlight the specific part you need to know. Unrealized gains and losses on the available for sale debt securities. What we are required to find out, historical cost of the available for sale debt security was. Now, this question is pretty interesting. If you just look at the top, we have been given the debit balance. Asset, of course, they are supposed to have a debit balance. Assets have debit balance. We know that from the very beginning when this all started. Then how can we have an OCI having a debit balance? OCI is a part of your equity. It's a part of your equity, and ideally it should have a credit balance. If it has a debit balance, then it means that this is the accumulated loss in the OCI that has accumulated related to its available for sale security. This is the loss. Absolutely, it's a loss. It's a loss. Now I'm going to write a formula which you can use to find the carrying value closing. So this is the formula. Carrying value O, that is the opening value. If there is a gain during the period in OCI, you add the gain. And if there's a loss, you deduct the gain, and that will give you the closing carrying value. Right? Because the gain is added, loss is deducted. So if your investments had an opening value, which we don't have, basically, we need to find the opening value of the opening carrying value, the opening cost. So what are you going to do? Keep CV0 as it is. There is no gain, basically, the gain is zero. Loss is there, 19,800. Minus the closing carrying value, it is given as 96,450. Now, if you make the carrying value opening as a subject of the equation, you will have to add this number to the right of your screen and it'll give you 116,250. So this was the original carrying value of your investment. Because there was a loss during the period, and this was the loss. Because of the loss, your original cost 116,250 had to be brought down to this number 96,450. So this means that was the original value. After the loss, it has fallen to 96,450. So that makes D to be the correct option. Okay, next. So this one. Investments classified as held to maturity are measured at what value? They are measured at fair value? No. Fair value with unrealized gains and losses reported in income statement. That is true for trading securities, not for available for sale. Available for held to maturity are reported at fair value with unrealized gains and losses reported in the other comprehensive income. No, that is for available for sale securities, not the held to maturity. Then the replacement cost. This is a nonsense term. There is no such thing as replacement cost. That is used in inventory, but not in the available for sale debt securities or any investment related to debt. Amortized cost with no unrealized gains and losses for fair value adjustment. This is the correct. Remember, this is the correct option. Held to maturity securities are reported at amortized cost, and that makes D to be the correct option. This one is little twisted, and I need your full attention to do it. The following pertains to Smoke Incorporated investment in debt securities. Okay, gentlemen, this requires some serious focus. On December 31st, year 3, Smoke reclassified a security acquired during the year for $70,000, and it had $50,000 fair value when it was reclassified from trading to available for sale. Please focus. You acquired an investment for $70,000. And now what you're doing, it had $50,000 fair value when it was reclassified from trading to available for sale. Now, since a trading security, which was originally acquired at 70, it is now being reclassified into available for sale. Whatever gain and loss, it has to be considered in the current year income. A $70,000 investment is falling to 50. So this $20,000 loss must be reported on the income statement for the current period. This is the first part. Second part says an available for sale security costing $75,000 written down to 30 in year 2. Remember, this happened in year 2. Your value 75 fell to 30. So yes, clearly there is a loss. But this loss goes to other comprehensive income in year 2. We are in year 3, so it means we have to go for year 3. So please, again, this second transaction says you had an investment classified as available for sale. It had the original value of 75. It was written down to 30 at the end of year 2, which means there was a loss of $45,000. This $45,000 loss was reported in OCI in year 2. Then, and this was because of other than temporary impairment of fair value, had a 60 fair value on December 31st, year 3. What happened? After that, there was again an increase in the fair value from 30 to 60. This 30 to 60 increase is for an available for sale security. So this $30,000 gain this time, this gain goes to other comprehensive income. So yes, there is a gain in year 3, but this gain goes to other comprehensive income. The question says, what is the net effect of the above items on Smoke's net income? Gentlemen, please attention. Attention, Salman. This $20,000 reclassification gain and loss, this goes to income statement. But since it's an available for sale security, any gain and loss on AFS, it goes to OCI. So it is not your income statement item. The only income statement item relates to this 20,000 reclassification. So it means the only item or the net amount that goes to the income statement for year 3 is just this $20,000. This $30,000, it goes to OCI, not income statement. Remember, OCI is an alternative bypass for 4 specific transactions. I hope you people remember: any fair value gain and loss on available for sale securities, defined pension obligation gain and loss, effective portion of cash flow hedge, and the foreign currency translation. We discussed these in detail in your unit 1. So right now, that's your answer. See, 20,000 decreased because of this first transaction. Second transaction has a loss effect, but that loss goes to the OCI, not the income statement. Next, KL company purchased bonds at a discount on open market as an investment and has the intent and ability. You have both the things, intention and also the ability to hold these bonds till maturity. So you want to have the interest income and the principal by the time the bond matures. Clearly, this is the intention to hold them till maturity. And held to maturity securities are reported at the amortized cost. Absent an election of fair value option, there is no FV option exercise. KL should account for these bonds at amortized cost because the company has the intention as well as the ability to hold on to these bonds till they mature. So you are going to report them at the amortized cost. That makes B to be the correct option. Next. Now, gentlemen, apparently a bigger question, but you have to read the information carefully. On July 2nd, year 5, Wine Incorporated purchased a short-term investment, a 1 million face value Keen Company's 8% bond for $10,000 plus accrued interest to yield 10%. The whole story is that you purchased a bond with a face value of $1 million and you paid $10,000 for it, right? And there is some accrued interest to yield 10%. That is not relevant. We discussed this yield, the percentage is the market value in your CMA Part 2, Section B, Corporate Finance, but not here. The bonds mature on January 1st, year 11, after about 7 years, and they pay interest annually on 1st January. Fine. On December 31st, year 4, the bonds had a fair value of $945. On February 13th, year 5, Wine sold the bonds for $920. Now, this is important. Let me mark two important dates that are relevant for the question. This is the value of the bonds on the balance sheet date once the year are closed. And after about 1.5 months, you sold these bonds on 13th of February, year 5 for $920. Now, the question is, on its December 31st, year 4, balance sheet date, what amount Wine report for the bonds if it is classified as available for sale security? We know, even it's a bond, since it has been classified as available for sale, debt securities, preferred stock, it is reported at the fair value, the value on the balance sheet date, that is $945. Even we sold them after 1.5 months, that is not an issue. The price at which we should report is $945, and that's what the question was all about. So you just needed to take just this number, and that was your answer, right? So that makes C to be the correct option. Okay, next, this is a good one as well. The information pertains to large corporations available for sale debt securities. December 31st, year 2, the cost was $100,000, but at the end of December 31st, year 2, the fair value was 90. The cost stays the same, but the fair value at the end of year 3, 31st December, it's 120. Now, what we need to do, the differences between the cost and fair value in both of these years are considered to be temporary, right? And remember, they are available for sale, which means we are going to consider the fair value, not the cost. The decline in fair value was properly accounted for in the last year, 31st December, year 2. The question says, ignoring tax effects, by what amount should other comprehensive income be credited at December 31st, year 3? You know that available for sale securities, any gain and loss, it goes to OCI. So what should be the gain and loss? So most of you will make a mistake and you people will say the cost versus 120, so it's going to be 20. No, it's not 20. It's not 20. Remember, at the end of year 2, 31st December, the book value of these bonds will be 90. Remember, year 2, 31st December, the book value is 90. When the next year ends, 31st December, year 3, the fair value is 120. So what you do, you compare the opening value of the investment with the closing fair value. The difference is either gain and loss, and that is what goes to the other comprehensive income. So this 90 versus 120 is your gain, not 100 versus 120, because 100 is cost, that is gone. So this is 30. So this $30,000, yes, Subhan, this $30,000 is the gain that needs to be reported in your other comprehensive income. All right, next. For available for sale debt securities, included is a non-current asset. Which of the following amounts should be included in the period's net income? Mind the word net income, net income, net income. Unrealized holding losses during the period. Wrong. available for sale debt securities, any holding period losses and gains, they go to other comprehensive income, not the net income. Realized gains mean you actually sold those investments. You actually sold those available for sale securities. Remember, the realized gain is the actual gain. So when there is a realized gain, whether it's available for sale or whether it is trading, realized gain are absolute gains and they must go to income statement. There is no second opinion about that. And the third thing, changes in the fair value during the period. If the fair value changes for available for sale securities, it goes to the other comprehensive income. So this is an important point. Any holding period loss and gains, any fair value changes, they go to OCI. They do not go to the income statement. Income statement will only be debited or credited for the realized gains or losses. So that makes only B to be the correct option, right? So that is the right answer. Okay, now a reclassification. This is the question that you should spend some time on. A reclassification of available for sale securities to the held to maturity category. Now, this is an important point. We know if a security is AFS, so far all its gains and losses would be reported in the other comprehensive income. It could be a gain or it could be a loss, right? So it could be a gain which is available in OCI, it could be a loss. So available for sale debt security is being reclassified into held to maturity. What we are going to do, this gain and loss, I hope you remember, since AFS is being reclassified as held to maturity, any gain and loss so far in the OCI, it must be now amortized. Why amortized? Because held to maturity securities are reported at amortized cost. Absolutely, Fahad, you're right. So any gain and loss, just like the premium amortization and the discount amortization, this gain and loss that is reported in the OCI, it is amortized. So look no further. This is your answer. This part is the amortization of unrealized gain or losses existing at the transfer date. And this gain and loss was there in OCI. No, Subhan, no. Unrealized gain and loss related to these AFS, which were there in OCI, they will be amortized. That's what we discussed. Let me take you back. Let me show you and what we did a little while ago earlier. This is an important point. You should have remembered this one. See this one, we discussed that. When an available for sale security, any gain on loss on this OCI is reported in the OCI, right? Any gain and loss. This gain and loss, when it is transferred AFS to HTM, this gain and loss is amortized, just like the bond or premium bond discount. Okay, fine. So we got our answer, but there are other options to discuss also. The recognition in earning on the transfer date of an unrealized gain and loss. OCI gain and loss is reported as a part of amortization, as just like a bond discount or premium. It is not released to income statement. This is incorrect. The reversal of any unrealized, there is no such reversal. No. The reversal of unrealized gain and losses previously recognized. This is absolutely wrong. We know for sure that any gain and loss available in OCI, it is amortized when an AFS is converted to held till maturity. So that I think covers. This is quite an extensive question, and if we start, it's going to take some time. But let's do it so as to explain the idea. In the same year, yes, in the same year, Gauss, in the same year in which this change took place. We can't take it carry forward because at the date of changeover, at the date of transition, this question is little twisted and little longer also, comparatively tougher than the exam standard, but it is trying to convey something important here. How do we consolidate financial statements and what are the adjustments that you may have to make? J Company acquired a wholly owned foreign subsidiary on January 1st. The equity section of the December 31st consolidated balance sheet is shown as follows. Common stock, additional paid in capital, which is called share premium in our part of the world, retained earnings, and accumulated other comprehensive income. And this is negative, means it's accumulated loss, it's debit. Rest of the items are credit. And this is the total equity credit. Now, listen to the information, listen to me what I'm saying. The balance in the accumulated other comprehensive income appropriately represents adjustments in translating the foreign subsidiary financial statements into the US dollars. Foreign currency translation, it's a topic discussed in your CMA Part 2, Section B, Unit 8, Subunit 8.3. This is not relevant here, the translation and any gain and loss. What is in we are interested in that how do these investments might have affected the retained earning and the accumulated other comprehensive income, and these two are also not relevant. So we are just looking at from the point of view what we're doing right now. The consolidated income statement included the excess of cost. Now, this is a very important information. Excess of cost in certain debt and equity securities over their fair values. This needs discussion. When the cost is more, let's say this is the cost, let's say, or let's take a bigger number, and the fair value is just $500,000. This is the cost, and this is the fair value. So this difference represents a loss. Now listen to me very carefully. If this is a trading security, this $200,000 goes to income statement. If it's a trading security, if it's an available for sale security, this loss goes to other comprehensive income. And if it's a held to maturity securities, we do nothing, right? We do nothing. Now look at this information. The consolidated income statement included the excess of cost of investment in certain debt and equity securities over the fair values, which is considered temporary, as follows. Available for sale debt security, their difference between the cost and the fair value was $200,000. The cost was more than the fair value. The cost was more than the fair value by $200,000. And second, equity securities, $100,000. The cost was more than the fair value by $100,000. Now, this is important, gentlemen. Again, this point here says the consolidated income statement included. Consolidated income statement included both of these things. We agree, any equity securities gain and loss, any equity securities, trading securities, its gain and loss is reported as a part of your income statement. But available for sale debt securities, its gain and loss, it does not goes to income statement. If you have charged this loss in your income statement, this is wrong. We have to correct this. We have to correct this incorrect loss which is reported in income statement. How do I know it's income statement? Here it says, the consolidated income statement included these two, $200 loss on AFS and $100,000 loss on equity. This is perfectly fine. Equity securities gain and loss for trading purpose, it goes to income statement, but available for sale debt securities, the gain and loss on these goes to OCI. So this is the mistake we have made. What we have done, we have charged this loss against the retained earning rather than carrying it to the other comprehensive income. So Subhan is very much interested in journal entries. So the journal entry we're going to make, gentlemen, we are going to reverse this loss in the retained earning. So we are going to credit the retained earning with $200,000 and OCI will be debited because this is the loss that should go to the OCI. OCI must be debited with $200,000. Now, what the overall story is, OCI already has a debit balance of $600,000. If you reverse this loss and goes to OCI, OCI will become $800,000 and retained earning, which is a credit balance of $900,000. This credit will increase the amount in retained earning from 900 to 1.1 million, and that makes C to be the correct option. Ya Fahad, the gain eventually goes to retained earning. Any gain and loss through income statement falls in the retained earning. The effect of retained earning, any gain and loss which should have been reported in the income statement, if you didn't do it, and if you have been given the retained earnings number, so this goes to retained earning only, right? So this $200,000 reversal will rectify your retained earning because this is the mistake in income statement, and that goes to eventually to the retained earning. So that makes C to be the correct option, and C it is. Next, when the fair value of an investment in debt securities exceeds its amortized cost, this is important. The fair value in debt securities exceeds its amortized cost. How should each of the following debt securities be reported at the end of the year, given no election of the fair value option? If no fair value option is elected, then how are you going to treat it? Try this question. Come on, what we have done so far. Held to maturity securities, how do we report them at the balance sheet date, and how do we report the available for sale securities? A fairly straightforward question. Yes, held to maturity are reported at amortized cost, and available for sale is reported at fair value. Absolutely right. That makes B to be the correct option. This was fairly straightforward question. Next. An available for sale debt security was purchased on September 1st, year 4, between interest dates. The interest was due. In the US, interest is normally paid semi-annually. So you may have bought in between these dates. The next interest payment due was February 1st, year 5. Because of the permanent decline in the fair value, the cost of the debt security substantially exceeded its fair value at December 31st. Now, the cost that you're carrying up, let's say it's $100,000, but the market has declined significantly down to $70,000. So cost is high, but the market value is significantly down. So what you're going to do? On the balance sheet, the debt security should be reported at what date? Even it clearly says available for debt security. And we know that available for debt security is reported at the fair value. Despite its permanent decline, you have to report this fair value loss. So you are going to report it at fair value. 100 less 70, this $30,000 loss goes to other comprehensive income. Right? So that makes B to be the correct option. Last question. The amount by which the fair value of a debt security exceeds its cost. Fair value is, let's say, $100,000 and the cost is 70. Take these numbers previously. How are you going to treat this difference in the financial statement if the security is a trading security and if the security is available for sale? In case of trading security, this fair value $30,000, it is reported as a gain in your income statement. And in case it's an available for sale security, again, there's going to be a 30,000 gain, but this gain goes to other comprehensive income. The question says the amount by which the fair value exceeded, how are you going to report trading and available for sale? Please do not forget, available for sale and trading securities, they are both reported at fair value. The difference is any gain on fair value in the available for sale securities, it goes to other comprehensive income. And in case of trading securities, it goes to income statement. So that makes C to be the correct option. And I think that what we could successfully do for today.